Hello friends, so today we are going to understand the delta neutral strategies. So in Nifty, we are going to deploy the delta neutral strategy for the monthly expiry. So we will see through the Opera simulator. Again, I am taking one more example. So if we just check the expiry January 2023, that will be on 25th of January. So we'll deploy the monthly strategy on Monday, that is 2nd of January. So let us deploy the strategy. So I'll go to the option simulator, and through this option simulator, what I'm going to do, I just have to select the date. So the date at which I'm going to deploy the strategy, that will be the 2nd January, and the expiry will be, which is a payoff date, we can say, that will be 25th of January. So again, you have to select here 25th of January as an expiry. So now you can just check it here. What is the spot right now? Now one more thing, that we are going to deploy the strategy at 3:15. So the important thing that we have to understand here is that which strategy we are deploying for the data neutral strategy and at what time we are deploying this strategy. So you can just check it out here. It's 3:15 right now on the 2nd of Jan. So now simple strategy that I'm going to show you over here. Basically, our area of interest is to understand the delta neutral. So how we have to make delta neutral, that is what we are going to learn from this strategy. So let us go to the option chain right now. And what I'm simply going to do is, if you just check on 2nd of Jan at 3:15, the spot is at 18,193. It means around 18,200. So we don't have to do anything with the spot right now. So what I'm going to do here, simply, if you can just check it here, delta. So see, these Greeks are very much important whenever we are into the option buying and option selling or any of the option strategies. But the separate video I'll make for this Greeks like theta, delta, this gamma, all these things. So I'll be making it a different video. So right now, just try to understand simply. If I'll just tell you 18,000, just brief introduction about the delta right now. 18,200 is the at the money. So it will be near about 0.5 side. So it is actually 0.5 means 50-50, we can say. So simply, if a simple example, if I'll give you, if this any strike price is having delta 1, it means what, how much the index is going to move, in that proportion this strike price will move. So simply, if I'll check for the delta 1 on the put side, if I let us see, so this is near about delta 1, actually we can say 98. So if market will move, and this is actually, we can say, price of it. So this is a 98. So if market will move 100 points, so it means what, delta will make this premium of this 17,000 addition by 100 points. So this last traded price will become 1,281. It will become 1,381. Other parameters are also involved in it, but at the same time, in a simple language, just try to understand. So to make it simple, let me again explain you. At the money, if you see 18,200, so if 0.5 means 0.44, we can say, or 55. So if 1 point movement is going to be there, then half of the premium will move over here. So that is the proportion. If 1 is the delta, then proportionally that much premium will move it over here. So now what our strategy, in this strategy, delta neutral strategy, we are not going to sell at the money. We simply, safer strike price, we are going to sell it out. So that is 0.2, 0.2. So it means what, simply, if the market will move 100 points, so this will move, premium will move only 20 points. So that is the proportion. So 18,200 is the at the money spot right now. So if the market will move to 18,300, the premium that can move for the call side, that will be only 20 points. So like this is 19.53. So simply let's say it is 20, so it will become 40 only. So whenever we are going to sell, so increase in the premium will be lead to a loss of money. So only 20 points multiplied by lot size, we are going to lose money. Similarly for the call side also and small the put side also. So in our this strategy, what I'm going to do it on the call side, I'll just be selling it out. So if you just check it out, the columns near to the strike prices, that is the call delta and this is the put delta. So again, coming back to the main topic, that is delta neutral strategy, how we are going to do it. Let us understand that thing. So simply what I'm going to do it here, point to delta on the call side, I'm going to sell it out. So this is 0.2, it is 18,750. So this 50 multiples we are going to avoid, but for the understanding, let us take, because this resembles to the 0.2 only. So I'm going to sell it out 0.2 delta from the call side, because at the start of monthly strategy, we will be on a safer side selling out 0.2 delta, and here it is 0.21, which is nothing but 0.2 is nothing but 20 only, 0.5 is 50, and in that proportion 1 is like 10 is like 100. So like that it is like this. So 1 is 100 only. So on the put side I'm going to sell it out. So now finally it will look like this. So this is what I'm going to see it. I'll never recommend this strategy to anyone because the loss is undefined. So expert traders only can do this, because on the call side or put side, if something goes wrong, then it will lead to a big loss. So this strategy, this video I'm making just to make you understand what is delta neutral strategy that can be combined with the hedge strategies, and like iron condor and all, many more strategies are there. So right now just try to understand. If I'll mix all the strategy, you people will not understand what is delta neutral. So just to make you understand, I'm keeping it simple. This is basically a strangle sell. So strangle sell is nothing but what? Selling out the out of money call and put. So away from the spot. So that is what we have to understand over here. So I have sold out. So you can check out the Greeks. So this is now the important area. Now delta of the call, whichever I have sold, that is 0.20. This is 0.21. So difference. So all the time this will be opposite side. Call side will be negative. Put side will be positive delta. So if you just check it out here, it is a difference is 1. So now what we are going to do is we are making the strategy at 3:15 on 2nd of Jan. So as our regular practice, we are going to check out all these things, because we are not a full-time trader. We cannot sit on the screen all the time. So we are going to check out our strategy between 3 to 3:15, 3 to 3:30, in between, whenever possible. We will just adjust within that half an hour. So this is the standard time that I have taken, that is the 3:15. So now the difference is 0. So it means that I have neutralized the delta. So on the both side. So move can come on upside, move can come on a downside. So just according to that, we have to adjust it. So it's a very simple thing, like delta, theta, gamma, vega, we have to understand. But right now we'll not go into the details of these Greeks. So separately video I'll make it to understand all these Greeks. Right now just concentrate on the delta only, and that simple understanding, like if delta 1 is there, so whatever is the movement in the index, proportionate movement will be there in the premium of that particular strike price of the option. So here neutralize delta, we have neutralized the delta. So now payoff chart, we can just check it out here. Now just we'll run our simulator. We'll go to the day 2. One more thing is there, this theta decay will give us the profit. So just I'll go one day back and again I will show you. So right now, whenever there is a market, will stay over here only. So like 18,200 is the spot near about. So if market will stay over here only, so what we are going to get daily, we are going to get the 785 rupees. So it will be plus minus, because other Greeks are also going to change. So according to that, this will also change. So daily that premium decay, whatever in that proportion, like 700, 800 rupees every day, we are going to get plus minus form, and as per the movement also. But roughly we can say this much amount if market will not move at all. So now I'll go one day ahead. So we are getting more than 750 actually. So this is the 1000 profit. It is showing exactly the next day. One more important thing, to sell out these one lot of call and put, the margin required will be almost 1.25 lakhs. So if we can make 1250 rupees, it means that we have targeted over 1%. So our target is like 2 to 3%. So like we can say 2,500 to 3,200, like that we can just target for our profit 2 to 3%, because to be on a safer side. So this is near less than 1% actually. So how much that we can get it within one day, because there was no movement actually. So now let us go to the see. And one more thing, the main important thing, that where we have to adjust all this position, because adjustment is must and important to understand over here. So now our rule is like 10 to 15 differences on the plus side or the minus side is fine, because all the time it is like +3 we will adjust, +1 we will adjust, -1 we will adjust. So that kind of thing we are not going to do it. Between -10 to 15 it's okay, or +10 to 15 anything is fine. Till 15 we are not going to adjust anything, because that will not create much effect, because many adjustments will lead to many confusion. So -3 is fine on the next day. Now we'll go to the next day, that is 4th Jan. Again it is 15, so near about it is fine. Also it is, you can see the it is a neutral strategy. The delta difference is higher, so we have our profit is decreased, but no issue, it is near about 15 only. We can adjust over here, but still our rule says that 10 to 15 is fine. So next day it is giving us a profit of 1,000, so it is again fine 18, but here also we can adjust. But let us see if the difference increases more. So now this is, we can say 18 to directly 29, the difference is there, and our profit reduced to 90 rupees directly. So definitely we have to adjust it. And now how we have to adjust, we'll go to the profit and loss. So I'll just check it out. Pre-off chart, the market is moving towards the downside, so we have to adjust the call side, because call we have sold, so it is giving profit. So profit and loss, we'll just go. So 2,522 rupees we are having profit. So if you just check it here, the current price is 13.1, so I'll just book it with the 13.1. 13.1, I'll be just booking it out. And now what I'm going to do it, I'll just check out the Greeks. So what is the put Greek right now? It is a 35. Delta is what? 35. So we have to adjust this 35 with the call side. So I'll go to the option chain. I'll check out how much is the, which strike price is having 0.235 delta. So here it is 0.35, 18,150 rupees. One more important thing, if it goes above the 0.5 or 50, it means that we are going in the money, so that we have to avoid. But if the such situation occurs over here, we'll see what happens in that case also. So now this is the payoff chart. Just we have balanced the put side and call side. Now we can check out the Greeks, and difference also you can check it. It is a 0.46, so it is fine right now. Theta is also, means now onwards, if the market stays over here only, means now spot is different, 17,018. So almost it is 400 points below the whatever the point where we have started this our strategy. So theta is 1,000, means every one day move with the same strike price, or we can say same spot, we can go in, we can get 1,000 rupees each day if market will not move. But that thing is not going to happen. So Greeks will just concentrate here, and we'll just move ahead by day one more day. So it is 32 again, and it is giving us a loss 532. The date is 9th of Jan. We can check it here what has happened. It is second. See, once we have created our strategy on 2nd Jan, so market was okay with it. Now it started falling down, so it is like a 9th Jan is over here. So the things are not in our hands. So just only thing that we can do it, that is the making neutral, delta neutral. So I'll just make it neutral, and we'll see that key which side is profitable now. These are the open side. Blue dots means these are the open positions. So we are getting 1,225 rupees in the put. So I'll just check out the how much premium it right now. It is current price is 64.4 is the put price. So I'll just book it 64.4. And now I'll go to the Greeks. I'll check it out. It is 0.53. So it means that it is at the money almost 18,150. You can check it here, 150. So it means it is at the money call and put. So now onwards it is very difficult to adjust, or we can say it is not difficult, but it is risky to adjust. But still we'll see what happens here. Because we will, once it will cross the 0.5, or we can say 0.50 -50 +50, it means we will be going in the money. Okay, so in the money, out of the money, all these things, if you're not clear with it, I'll just explain it in the other video when I'll be talking about the basics of options and all option chain. So for the time being, just try to understand that 0.53 is there for the call. So put side also I have to adjust with the 0.53. So where I can just get the put point, let us see. So here it is 0.53. It means what? I can just go with this 51 it is. So I can go with this, or also I can go to 50. No issue. So I'll just sell it out the strike price. Now I'll see the how much is the difference I'm getting. Now the difference is point minus. So it is fine now. It is very minimum. So we cannot make it always zero. So the loss is 532 rupees. Now we'll go one more day ahead, because whatever adjustments we are doing at 315 only. So now again the problem is there, like it is giving a loss of 2500. It is almost 8 days after the strategy we have created. So again the problem is that 28 is the positive delta. So now we'll see where I'm getting the profit or loss. There is both the legs are in the loss. So I will just check out the payoff chart. So it is going little down. So I have to adjust the call side and make the premium that equal to the basically as per the delta neutral strategy. So 18,150. So it is at 126. It's only 1 or 2 rupees of loss, not much loss or a big loss. So I just simply have to check the Greeks again here. It is 65. So as I told you already, it is risky because it is in the money. So I'll just check it for the 65 call premium. So that is nothing but 0.65 actually. But here some different language we are using. So it will be 0.65 on the call side. So we can check it here. So we'll sell it out because it is in the money only. Call side. Put side is also in the money. So again we have neutralized it is 0.76. So we can check it out. Minus 2500. Definitely that loss will be there. Now we'll just go one more day ahead. Again there is a roundabout or delta difference is 5, so it's fine. Again little loss is decreased, but still in loss. Now it is one day more, so loss is decreasing. Delta is also within our range of adjustment. Now next thing is, again see now delta is also, the delta difference is also less, and we are into profit 7044. Fine. See, we are not even looking at the chart also, we are just looking out the delta and we are according to adjusting it. Again it is giving 1600. It is more than 1% of profit, and here it is within range, that 10 to 15 wala delta difference. Again now date is 17th of Jan, so 24 is our expiry date. So again it is around about near range 2500 is the profit that we are getting it. So again 1900, so adjustment is required. Okay, so if we will just check it the previous day, it was around about 17, so 15 17 16 17, so not much difference, but this difference will increase, then loss will increase. It is 2500. Now very next day it is giving us almost 600 minus it is going, so still it is in profit 1900, but now the difference is 35, so we have to adjust it. So what we'll do, we'll just adjust this put, because put is in profit, because always we are going to book the profit side. So 126.75 is the current price of 18,200 put. You can just check it from here. 126.75 modified position. Here was the position, here current price. Now it is, we have booked this, and this much is the profit we are getting. Now again we'll go to the Greeks. So it is at, see, 85 is also too high. We are deep in the money now. It's very dangerous to adjust over here, but still what happens, let us understand. Minus 885. So put with the same premium, with the same delta, we have to sell it out. 85. I think it is called. So put, we have to check it out. 85. So here it is 18,500 put we have to sell. because we are very much near to the expiry now. Now we'll check it here, payoff chart. So it is balanced. The Greeks also we can check it. It is, we have balanced the 0.12. It's very normal now. Again, one day more will go, 20th Jan. So 2700 again we are getting it, and new delta is 8 difference basically. 20 Jan 3100 rupees we are getting. Delta is also within range. No need to do any adjustment. Again 3900. So if we just check it here, so it is more than 3% right now profit we are getting it. Delta is also within range, so no issue. So this is I think last day of expiry. So delta is still balance one, and we are getting a profit of 4,000 something. So it is about 3.5% roundabout with respect to the margin that we have used. So this is how we have to do the delta neutral strategies. It's a very simple example that I have taken into consideration. But the thing is that there's a lot of risk is involved. Don't go for this strategy, because if it goes up or down, if gap up opening, gap down opening, so it will give you a big loss, because we are not doing any kind of hedging over here. We are not buying anything over here. Also, this is a plain strategy just to make you understand what is delta neutral strategy. Many people are doing it here, but they know their risk management and everything. So I'll not advise to do this. Just for the sake of understanding, I have created this video. So thank you everyone.